Everyone, it's Wednesday afternoon. I am done with work for today, which is always a wonderful thing. Um, I am really excited. Things are really kind of moving and grooving. And so I wanted to talk a little bit about the deadly sins of bookkeeping. And I bet you didn't know bookkeeping has deadly sins. They are not greed and lust and gluttony. They are simple things that people tend to do a lot that mess up their books. And the reason we refer to them as deadly sins is they really seem pretty innocent at the time. The seven deadly sins, of course, are lust, greed, gluttony, well, dang, now I'm going to have to look it up. But they start off as really not being a bad thing. The seven deadly sins are gluttony, lust, greed, pride or hubris, especially if it's hubris, despair, wrath, vainglory, and sloth. I'm not sure what they mean by vainglory. But those are the seven deadly sins. Oh, envy. So lust, gluttony, greed, sloth, wrath, envy, and pride. So we're going to talk now about the seven deadly sins of bookkeeping. And they are not keeping your receipts. It's a little bit of a less of a sin today than it was, even a few years ago. Not keeping track of where you're spending your money. The second one is not accounting properly for large purchases. A lot of people will try to expense them. I'm going to go into that in a minute. The third one is doing your own books or letting your spouse do them. I'm not sure if they should be the same or separate, but that's a no-no. And I'm going to explain why. And it's not because you don't know how to do them. It is, I'm going to explain it. Commingling funds, using the wrong basis, and letting too many people have full administrative access to your books and not backing up your files. I think that's seven. Is that seven? I think it's seven. I'm not counting. I should have like placards, but I don't because I was doing this at the last minute. Maybe I'll redo this later and have like number one come up. I should do this later and have, a picture come up. But for now, you get to just listen to me talk about it. So, number one, save your receipts. Really, save your receipts. If they're thermal paper, scan them in. The IRS, the reason for that is especially if you buy anything, anymore, every merchant everywhere wants to supply everything from apples to zebras. I mean, I swear, every merchant everywhere, they don't want to specialize in one little thing. Even Barnes & Noble, it's one of my very favorite stores because I'm a bibliophile in a huge way, and that means I absolutely love books and I read voraciously. You go into Barnes & Noble and they've got a coffee shop there. I mean, it's like they don't want to, that's great. I love that they do, but, and they have journals and they have pens and they have things that are kind of sort of related, but maybe not. And really what I want them to sell is books and not lap desks. So having a receipt helps your bookkeeper a ton, especially if you're going to the big box stores. Like I said, some of them that would seem to be obvious. Best Buy. Best Buy is my other big favorite store because I love computers. But you know what you can buy at Best Buy? You can buy car audio equipment and video games and TVs, and it's not necessarily computer supplies. They do have computer supplies, but then again, so does Office Depot. Like I said, there doesn't seem to be a specialization like there used to be. It used to be if you went to the office supply store, you bought ink and pencils and paper and pens and planners and that stuff that you used in the for the office, and you went to the computer store for the computers, right? Well, now, like I said, nobody wants to leave any money on the table, so they are supplying everything. And things have changed. Things have changed a lot. Now, computers are not prohibitively expensive. Just as a side note, I remember as a little girl going into Radio Shack back when that was a thing, and playing with their computers there with my dad. And I was probably in kindergarten, so dinosaurs were still roaming the earth at the time. But I would go in and I would be telling him, oh, let's run this program, and I'm going to do this, I'm going to do this, I'm going to push this to save. And I've always loved computers, and my dad would just be freaking out because it was a $10,000 computer. Now, I mean, we have computers for everything. This is a computer. This is more powerful than what they used to go to the moon. I have my desktop that I'm broadcasting from. I have my kid's desktop next to me. I also have a laptop and a tablet, and both of my kids have smartphones. So that's a lot of computers. And they're only a couple of $100 a piece. Mine has double monitors. I don't know if I want to show this, but I have 2 big monitors and an ergonomic keyboard because I have wrist issues. So my whole setup probably cost $600, as opposed to, as a kid, when it was thousands, it would have been $6,000, and it wouldn't have had anywhere near the storage or the memory or the speed or the capability. So it's just kind of a sidebar. But you got to have your receipts so that your bookkeeper knows where to put that money. Now, the IRS is loosening up a little bit if you purchased items with your credit card or debit card, because there is a trail then that they can follow. But it's easiest to just have the receipts. Again, if they're thermal paper, you're going to want to take a picture of it or scan it, and today's technology, just take a picture of it with your phone and send it to your bookkeeper, and she can attach it to your software, and then it's always there. It's so ridiculously easy today. Your receipts should prove to the IRS that these really were tax write-offs. I'm going to go back to the big box stores things again. What can you buy at Walmart? You can get your car worked on. You can buy tires. You can get toys for your kids. You can buy food. You can use the pharmacy. You can buy fishing gear and camping equipment and just about anything. So when you go to Walmart and you say, I went to Walmart and I spent $200, the first thing I'm going to ask is, great, what did you buy? Because, like I said, merchants are not specialized anymore. They want to serve everything. And those receipts are very valuable evidence to the bookkeepers to be able to figure out where to categorize that money. By the way, we are not the judge, jury, and executioner of your finances. I don't care how you spend your money, but I am going to tell you how to spend it so that it works best for you. So that you're not ever in trouble with the IRS, so that you are everything is accounted for properly. As far as what you spend your money on, I may give you a little bit of feedback, like you are kind of going to McDonald's 5 times a day. You might not want to do that because you're spending your sales tax money. But that's about as far. I mean, I honestly don't have any energy on your money. I just want to report it correctly. Number 2, inaccurately accounting for major purchases. Ugh. I just washed my tongue and I can't do a thing with it. We were just talking about computers, okay? So I have my 2 monitors and my big desktop tower, and I absolutely love my setup. And my concern is that this is going to last me for 5 years. It may last me longer, but the expected life expense I really can't talk today. I don't know what's going on. The life expectancy of my computer is about 5 years. And that life expectancy varies based on what you bought. And so when you buy a computer, I need to know that that's actually what it was. Again, you can go to Best Buy and you can buy peripherals, mouse, keyboard, software that need to be expensed. But if you're making major purchases, we can depreciate that over 5 years. Rather than showing a loss in the first year and a profit in the next 4 years, we can kind of spread that out. And that's really it's really what we want to do. We want to depreciate that over the life expectancy of your purchase. So like I said, a laptop or a PC is expected to be useful for about 5 years. Cell phones, I tend to replace my cell phone every other year, so I would only depreciate it over 2 years. Because we carry them around, they get dropped, and the technology on these is growing so fast. It's exploding. Number 3, commingling. What is commingling, you ask? Well, that's when you mix up your business and personal money. The way I like to explain commingling, I have 2 kids that are teenagers, and Jared is 14 and Mercedes is almost 16. I mean, like within 2 weeks she'll be 16. They both live in my house, and they do a lot of things together. They get along really well for siblings. But Mercedes cannot go and take Jared's money and spend it. Jared cannot take Mercedes' money and spend it. The same thing with your company. Your company is separate from you. Hopefully you've got it set up at least as an LLC. That's the easiest way to do it. In which case it is a separate entity from you. You should not be spending your business money on personal expenses any more than you would go and spend your friend's money. However, you need access to that money, right? The way you do that is you take your personal account and you take your business account. They should be separate accounts. And if they're not, we have a huge mess. You take money out of your business account and you deposit it into your personal account. Then you can spend the money for your personal expenses. Sometimes it seems a little bit redundant. I mean, I do this too. I have my business account. I actually have 2 checking accounts. One is for spending money, and the other one is for holding for my major expenses, rent, car payment, travel, and I kind of keep that separate. And so it's easy to think, well, I'll just pay this bill out of my business account because that's where the money is, right? Instead, I will actually take the time to move that money to the proper account and spend it out of there. And it just makes it easier to account for. Also, it keeps the IRS from seeing a red flag. If you are commingling like crazy, your books are probably not going to be right. I mean, I'm going to do my best to make them right, but they may not be, because you're spending your business money on your personal stuff and your personal money on your business stuff. The number one offender on this is the very small business owner, especially if you're a consultant of some kind. Someone like me, I kind of live and breathe my business. And so it's easy to say, you know what, everything I do is business. Except that it's not. It's easy to try to get really creative with the write-offs and say, well, you know, if I take my kids to Disneyland and I talk about business while I'm there, then it's a business trip, right? No, I wish. Um, you have to be, be mindful that it's not just what you believe that matters. It really comes down to what the IRS says, and that's whether or not, I say that it is. I don't do taxes, but I will tell you there are rules and guidelines that you have to use when you're doing accounting, or you're going to have problems later. You're not going to be able to get investors. You're not going to be able to file accurate taxes, and that's going to cause you headaches way down the road. And I don't want that to happen to any of my clients. So don't mix personal and business funds. Stop it. Stop it right now. Stop it. Keep them in separate accounts and transfer the money as you need to, but don't spend personal expenses out of your business account. Make that transfer. Don't spend business expenses out of your personal account. The one exception to this is when you're very first starting and you don't have a business account yet, because you need to be registered with the state to do that. So that's the only exception to that rule. If you have business expenses that need to be paid, pay them out of your business account. Vital. This is vital. Not using the right basis. That's number 4, right? I use the accrual method by default, and that is mostly because that's what my financial software uses by default. The difference is, you may talk to your accountant or your tax preparer and they'll say, what basis are you using? I prefer to use accrual. It is the most accurate. This is the difference. When you are using cash basis accounting, you have earned the money when you get it in your hot little hands and put it in your bank account. When you're using accrual accounting, you earn that money when you invoice for it. This is where you have payables and receivables. Cash accounting doesn't have payables and receivables. Accrual accounting does, but accrual is more accurate. Now, with that being said, I use accrual by default in QuickBooks. In all the financial software I use, I'm using quite a few programs right now. So I can produce reports in cash, but my preference is to have all of my clients in accrual, and that's because it's actually more accurate over the long term. But it says, inaccurate financial statements. One is by using the wrong basis. Number 2 is, this is number 5, not communicating with your bookkeeper. If your bookkeeper has questions, if she's working in my company or in any company that I'm associated with, I will have her put those transactions in an account called Ask My Accountant. It is sometimes also called suspense. It is sometimes also called uncategorized expenses. It is just an account that we have set aside to kind of hold those transactions. If you think of it as a bucket, we're going to put that money in a bucket where this is, we don't know which bucket this goes into. And then we're going to reach out to our clients and say, what was this for? And until we hear back from the client, that money stays in the uncategorized category. And the fact that there's money in the uncategorized accounting category means that your reports are inaccurate. They may give you kind of a broad overview, but they are really inaccurate until we figure out where this other money goes. So if you are not communicating with your bookkeeper, then that uncategorized expense account is growing, because we always have questions, and there are always questions that only you can answer. I have a magic 8 ball, but it doesn't, and I have a crystal ball actually, but they don't tell me what you spent this money for. I really need you to do that. And I really hammer that. We actually had a client that told us to figure all this out because that's what he was paying us for. And I was floored because the only way to do accurate accounting is to have the input of the client. That's the only way. So if you are not communicating frequently with your bookkeeper, that's number 5. And by frequently, I'm going to kind of set the standard on this. If you are on the catch-up program, you need to be communicating with your bookkeeper. And I mean, if she doesn't reach out to you, you reach out to her. No less frequently than monthly, and probably as often as weekly. If you are caught up and are up to date, no less frequently than quarterly, and possibly as frequently as monthly. Because questions come up, and it's so much easier to answer those questions if there's frequent communication. Also, if there's frequent communication, believe it or not, several years ago we had a client that dropped off the face of the earth, and we didn't know what happened to him. It turned out that his son had died suddenly, and he was depressed, and he wasn't reaching out. That's kind of one of those things that we do need to know. We need to know whether or not to worry about you, because we care deeply about all of our clients. Another one of my clients had major surgery, and I had no idea. And I don't like being wrong-footed like that, thinking that, oh, he's just ignoring me when he was in the hospital. But so communicate with your bookkeeper. Communicate with your bookkeeper. That's number 5. Make sure that you're communicating with your bookkeeper, because failure to communicate is a deadly sin. Number 6 is allowing too many people to have full administrative access to the software. And it doesn't matter which software it is. It could be QuickBooks or Xero or Zoho or whatever. Peachtree. I don't even know what's on the market anymore besides QuickBooks. The reason is administrative access gives access to absolutely everything. So your bookkeeper needs to have full administrative access. Everybody else should have limited access. If you have someone that just does payroll, they should only have access to do payroll. They shouldn't have access to do anything else. They should all have separate usernames and passwords, because if, for heaven's sake, someone goes and deletes a whole account that's critical to the accounting process, we would like to know who that is so that we can reprimand them nicely and tell them you can't do that. Believe it or not, that's happened. I've had everything that can possibly happen in bookkeeping has happened to me. You need to know who is doing what in your books. Ideally, I mean, for the clients that I have, they're usually very small businesses. They're usually just like a mom and pop. They might be a subcontractor. They may even be making a lot of money. But usually they are not big enough to require more than one person in their books. So when they outsource to me, I'm probably the only one, with the exceptions of my team, and I know what's going on there, who have access. I'm probably the only one with access. If there's someone else with access, everybody needs to have their own username and password. I keep kind of harping on that. And you need to, that's because in financial software there's a thing called an audit trail. And that means that we can go back and see who did what. Whether it was they added a bill, or they paid it, or they prepared something to be paid, or they entered transactions, or they reconciled accounts. There is an audit trail in financial software that lets us know what's going on and who's doing what. And you want to use that. And that's so that there's a tendency to blame the bookkeeper, and the bookkeeper also has a tendency to blame the client. When you have separate usernames and passwords, then you know who's doing what, and there's a lot more accountability and a lot more clarity. Also, you don't want too many people having full access to your books, even if they do have a username and a password, because too many people that are mucking around, it can get messed up pretty quickly. It's better to just have one person have full access, maybe 2 people, and then, for example, if you give me full access, I can work with my bookkeepers and we can decide who's going to be doing what instead of, they say that, the right hand doesn't know what the left hand is doing. And when that happens, it turns into a mess really quickly. So don't allow administrative access to everybody. Only allow it to those people that actually require it. And everybody should have their own username and password to your financial software so that everybody knows what's going on. So that's number 6. And number 7, not backing up your files. I almost want to say, even if you're using an online program, have a way of backing up your information. It's just better that way. If you are using a desktop software, that's kind of my personal preference, because if my internet goes down, I can keep working. And internet does go down from time to time. Whether it's desktop or internet, you've got to have a way of backing up your files that you control. You want to keep your data, your records, both online and offline. And something that I want to talk about in a later video is to have a disaster plan. Most small businesses that go through some sort of a disaster aren't able to come back from it. But I wouldn't even rely on having your information in the cloud as a reliable backup. I would still back it up on a regular basis. Just because things happen. The unforeseeable happens, and the reason they call it unforeseeable is you can't even imagine that would happen, so it'd be better to have everything backed up regularly. So those are the 7 deadly sins of bookkeeping, and I am going to be done for the day, and I am looking forward to talking to you again tomorrow. Have a great evening.